Philip Fisher. The name may not resonate like a Henry Ford or a Walt Disney, but in the world of investing, his influence is profound. Born in 1907, Fisher wasn't a Wall Street tycoon. He was a deep thinker who saw beyond the ticker tape. Fisher founded his firm in 1931 during the Great Depression. Talk about bad timing, right? Yet his philosophy of meticulous research and long-term vision took shape. Fisher was a hunter of enduring value. He wanted to own a piece of a truly exceptional business, and he was willing to wait for the right opportunity. His book, Common Stocks and Uncommon Profits, published in 1958, became a gospel for investors. It laid out his investment principles, influencing everyone from Warren Buffett to countless individual investors. Fisher's philosophy can be summed up in a simple yet powerful phrase: scuttlebutt. Imagine yourself back in the day, leaning against a neighbor's fence, catching up on the latest gossip. That's scuttlebutt. Informal, anecdotal information that gives you a feel for what's really going on. Fisher believed that numbers tell only part of the story. To truly understand a business, you had to go beyond the balance sheet. Talk to customers, competitors, suppliers, and employees. Get your boots dirty, so to speak. He championed the idea of investing in companies with a durable competitive advantage. These were businesses with a unique edge, something that set them apart from the pack and allowed them to thrive over the long haul. Think of it like a moat around a castle, protecting it from competitors. Fisher wasn't afraid to hold on to a stock for years, even decades, as long as the underlying business remained strong and the management team continued to execute. He understood the power of compounding, how small gains reinvested over time could snowball into extraordinary returns. In Common Stocks and Uncommon Profits, Fisher introduced his now famous 15 points, a set of qualitative and quantitative factors to consider when evaluating a company. These points weren't meant to be a rigid checklist, but rather a framework for thinking about businesses in a holistic way. Some points focused on a company's financial strength. Did it have strong profit margins? Was it efficient in managing its assets? Others delved into the quality of management. Were they honest and competent? Did they have a long-term vision? Fisher placed particular emphasis on a company's research and development efforts. He believed that innovation was the lifeblood of a great business, the engine that drove future growth. He also looked for companies that were obsessed with their customers, constantly striving to improve their products and services. At the heart of Fisher's philosophy lay a simple yet profound belief: invest in people, products, and progress. He believed that a company was only as good as the people running it. He sought out companies with exceptional management teams, leaders who were passionate, ethical, and forward-thinking. Products mattered too, of course. Fisher looked for companies that made products or offered services that people loved and relied upon. He understood that a loyal customer base was a powerful asset, providing a steady stream of revenue and profits. Finally, Fisher was drawn to companies that embraced progress. He wanted to invest in businesses that were constantly innovating, adapting to changing market conditions and finding new ways to grow. He believed that the best companies were never content with the status quo. They were always striving to be better. Section 5. Case study: a timeless tale of Motorola. Let's bring Fisher's principles to life with a real-world example. Motorola. In the 1950s, Motorola was a relatively small company, known primarily for its car radios. Fisher, however, saw something special in Motorola. He was impressed by the company's commitment to research and development, its focus on innovation, and its strong management team. He believed that Motorola was well positioned to capitalize on the burgeoning field of electronics. Fisher's investment in Motorola proved to be a masterstroke. The company went on to become a global leader in the semiconductor and mobile phone industries. Its stock price soared, turning early investors like Fisher into millionaires many times over. The Motorola story illustrates the power of Fisher's investment philosophy. By focusing on the underlying fundamentals of the business, its people, products, and potential for progress, Fisher was able to identify a winner long before it became obvious to the rest of the market. Section 6. Navigating the Seas of Change. Fisher in the 21st century. The investment landscape has changed dramatically since Fisher's time. The rise of the internet, globalization, and lightning-fast trading algorithms have created both opportunities and challenges for investors. So are Fisher's principles still relevant in the 21st century? Absolutely. While the tools and technologies available to investors have evolved, the fundamental principles of sound investing remain timeless. Fisher's emphasis on long-term thinking, meticulous research, and investing in companies with a durable competitive advantage is just as relevant today as it was decades ago. In fact, in today's fast-paced, information-saturated world, Fisher's principles are perhaps even more important than ever. With so much noise and hype in the market, it's easy to get caught up in the latest fads and lose sight of the fundamentals. Section 7. The enduring legacy of Philip Fisher. Philip Fisher passed away in 2004 at the age of 96, leaving behind a legacy that continues to inspire and guide investors around the world. He was a pioneer of growth investing, a champion of long-term thinking, and a firm believer in the power of compounding. His influence can be seen in the investment strategies of countless individuals and institutions, including Berkshire Hathaway, the investment conglomerate led by Warren Buffett. Buffett, a self-proclaimed disciple of Fisher, has often credited Fisher with shaping his investment philosophy. Fisher's impact extends far beyond his investment success. He was a generous philanthropist, donating millions of dollars to educational and charitable causes. He was also a vocal advocate for investor education, believing that everyone should have the opportunity to achieve financial security. Section 8. Beyond Common Stocks, a Legacy of Wisdom. While Common Stocks and Uncommon Profits remains Fisher's most famous work, he also authored 2 other books, Conservative Investors Sleep Well and Developing an Investment Philosophy, both of which offer valuable insights into his investment approach and philosophy. In these books, Fisher delves deeper into topics such as risk management, portfolio construction, and the importance of emotional discipline in investing. He stresses the importance of having a well-defined investment plan and sticking to it, even when the market gets choppy. Fisher's writings are characterized by their clarity, common sense, and timeless wisdom. He doesn't use jargon or complex formulas. Instead, he explains his ideas in plain English, making them accessible to investors of all levels of experience. Section 9. A final word. Investing for the long haul. Philip Fisher's investment philosophy can be summed up in a simple yet powerful message. Invest in great businesses, be patient, and let the power of compounding work its magic. His principles, rooted in meticulous research, long-term vision, and a deep understanding of business, remain as relevant today as they were decades ago. In a world of instant gratification and short-term thinking, Fisher's message is a refreshing reminder that true wealth is built slowly and steadily, brick by brick, over time. His legacy continues to inspire and guide investors around the world, proving that the principles of sound investing never go out of style.